Dude, Tesla with the 21% day. 21% day today. Really, all this move and NASDAQ is up 81 basis points. So that's pretty interesting.
Yeah, there's definitely some pressure on equities. It's
It's,
doesn't
yeah.
feel the same as it did just a month ago.
It's not, I don't want to, I would say that it's more characterize it as more of like a silent wait. I almost think, it's like, they don't have the same fire. Like Nasdaq is still trading where it was back in July. We haven't actually like gone higher since the July high yet. I mean, it could happen as we like continue to base and like hold this mid vamp level. We could finally get a snap above and like a push to the July highs. But the fact we haven't made new all-time highs on the Nasdaq yet is quite interesting.
What do you think is holding the Nasdaq back while the S&P is making new highs?
I think there's a variety of things, but I'd probably say the first thing is probably rates. I think the way rates have moved, right? Like we've come up quite a bit since, like, let's take a look here. Let's take a look here on rates, right? Like ever since July, we sent lower and we've recovered on rates. But I think like the change in trend, like rates were falling and the market was liking that as like a disinflationary environment where you had rates coming in and you had commodities. I believe commodities at the beginning of July were also like coming in. So disinflation, they weren't crashing up until like September, late August, early September, where they started really accelerating down commodities and rates were pretty much doing the same thing, gliding lower. I think that was really good for equities. In terms of like that's what the not I don't want to say good for equities, but that's what equities wanted to see, right? So if you look at QQQ, we had the initial pullback and we snapped back most of the losses from the July unwind rather quickly. But I
Yeah,
think it's
because
that
it's like pushing the recession odds off the table, but then you still have the high yields, which affect the high growth tech companies in the Nasdaq more than the S&P.
right. So like if you look at yields, like yields started like they dove lower on the July NFP print, right? The July August NFP print, they fall. And with that Nasdaq comes down. Then what ends up happening here is pretty interesting, where yields go lower, Nasdaq goes up, pretty much falls down again, right? And then it's when yields start like reversing, like holding the bad for stocks only level above there, which is 4% on the 30 year. The 30 year can hold that barrier. This is like what allows stocks to like break up out, off the August through the August highs or the late August highs. And then as the 30 year climbs and accelerates towards like the bad for both barrier, which is 4.3, you notice like a major slowdown, right? Like yields rip and like the NASDAQ is pretty much close to the same levels as it was when the 10 year was at 4.13. Now, that's what meant to like, or was alluding to at the beginning of the podcast, saying like it's a silent drag. It's not severe, but it's definitely noticeable in risk assets. So you're not getting that like let go risk on activity, at least not yet. And I think it has to do with yields being where they are, the election around the corner. I mean, we have that in like literally 2 weeks, right? So we have this election in 2 weeks. We have yields higher than where they are, commodities holding up, but like not as bad. If we take a look at commodities are actually lower than yields. So commodities have pulled back. It's a good sign, but they're in the soft landing ranges right now. Yields are above, but ultimately with the election around the corner, I think it's just something where we're gonna have to let that pass to really figure out for people to really figure out what they want to do.
Yeah, there's just so much uncertainty in the air right now. And at the end of the day, we are in risk off and deflation. So, as per our system. So, that's also just going to have a drag on equity performance. And we are getting a confirmation that that regime is correct by what we're seeing in gold. I think what we're seeing in bonds with this pullback, a lot of it is political implications that are playing a part in that and default risks, which gold doesn't have. So I think
Right.
gold is telling us that we are in the right regime. We are right about the regime, but bonds may not be the proper allocation in terms of these political risks, but is that something that's going to come to fruition or even fully play out? That's up for debate. I think the market's really just front running it with this, with what gold is telling me.
Yeah, I think your point there is pretty much spot on. If we didn't have an election around the corner, like take a look at this, right? I'm going to overlay a few things. So like let's overlay utilities, let's overlay gold, right? So we'll just overlay these three things. So we got utilities, gold, pretty much in line, right? Utilities and gold. The disconnect here is bonds, right? Rates. In terms of, and even something like SPY to QQQ, right? So we're saying like S&P 500 outperforming the Nasdaq, right? So like let's do that too. Let's throw that on the right.
Yeah, so that's
And
that ratio. Basically, what you're doing with that is you're isolating the rates out of equities, right?
no, it's a Nasdaq, it's a S&P to Nasdaq. So what we're doing is we're trying to see how much is the S&P outperforming the Nasdaq in a real risk-on environment. Nasdaq should outperform Nasdaq should outperform S&P. S&P should not be outperforming tech,
Yeah.
right? And what you're seeing here is you're actually seeing, if we throw this ratio into a new pane below, we're not seeing like the typical, like we zoom out, like you'll see like this is in risk off environments, this ratio goes up. In risk on environments, this ratio goes down. So you're seeing like a very leveled approach here. This isn't really breaking down. You're not below the September or the August, the August or September lows on the ratio. You're holding above those. You have utilities at highs. You have gold at highs. So there's obviously some risk off pressures in the market, but you also have bonds getting just absolutely whacked the last 2 weeks. And I think that it's primarily because of the election. If there was no election in the next few weeks, I do think that nothing like, so for example, in the last month or two, we've got, as we approach the election, I think the market's gotten more sensitive to each candidate's policies, and whichever candidate is leading, the market's going to be hypersensitive about their policies and their implications on the deficit. I think that if there was no election, you would not have that fear mongering getting jacked up into the market so quickly, because in reality, the deficit is like, we kind of know what Trump is going to do with the deficit, right? To some degree, we had him in office already for 4 years. This is not like some random person who's never been in office. We're not sure what they're going to do. Trump does a lot of talking. He does deliver on some things, but he also doesn't deliver on a lot of other things, right? So it's like, is he going to make a 0% federal income tax? Is he going to do all these things? Or is he going to pull an Elon Musk where he kind of shoots for the moon and just lands on the stars, or shoots for the stars and lands on the moon, however you want to put it, right? Like we have to see how he approaches this with actual execution. We know that he used tariffs in his presidency as a negotiating tactic. We know he did put tariffs in place, and that the current administration didn't even remove some of those tariffs. So it's like, if those tariffs have been in place already, a big factor here would be cutting the taxes and then additional tariffs to offset the change in government income, which would increase the deficit, right? That's really what the market's afraid about. And obviously Trump is big on tax cuts, and you kind of need to offset the tax cuts with some sort of revenue source, if it being tariffs, whatever it may be, to prevent your deficit from blowing out. I think the important thing to take away from all this is, I think the market is getting kind of scared or getting in front of its skis in terms of like what Trump's going to do to the deficit. In reality, we already had Trump in office running a sub 5% deficit. So that means a deficit below 5%. It's actually worse than that right now. So if we go back to the pre-pandemic period, get COVID out of the way, if that scenario is possible, Trump should actually be net positive for the deficit. He should actually lower the deficit in a sense. But the bond market is going to take what it's reading on face value and run with it. So
Yeah,
that's
I
obviously what we're
think
seeing.
I think another thing too that comes into play, so that's the inflation side of things that the market's looking at, but then also the growth side, Trump in his last presidency was very good for growth. And that's also going to bring bonds down. If he does bring back growth, which it's been lagging lately, if he does bring back super strong growth like he did last time, that's not going to be good for bonds either.
True, this is true, and I think that it's the culmination of everything hitting the table at once. Because over the last 6 to 8 weeks, Trump's odds and Kamala's odds have been widening quite a bit. Like, a couple of weeks ago, maybe a month ago, they were paired at 50-50, right? And we've seen the odds since split where Trump's taken a lead. And that's pretty much that divergence almost coincides perfectly with the bonds selling off as the market gets more confident that Trump has the winning slot in the race. Um, they're basically selling off in anticipation of, should I say, further budget issues in terms of deficit potential. We're widening, right? Like, and this happened, interestingly enough, the first time he was elected. If we go in the 30-year back when he won the 2016 election, what you'll notice is literally in the days after the election. So the days following the election, the 30-year ripped. I mean, we're talking, from a 2.5% base, 2.55, all the way up to like 3. So we ripped over like 50 basis points in a couple of weeks, in a month on the 30-year. And what you'll notice is like we peaked and we didn't really, we tested it one time in mid 2018. We went slightly above late 2018, but we didn't really blow through that. So I've seen some comments on X pretty much allude to the same thing, that if Trump can deliver on what he is, what he's proposing without really blowing out the deficit, the market might be ahead of its skis right now in terms of where rates are going. We might be near a top in terms of like the Trump pricing, given we went from like sub 3%, sub 4% on the 30-year all the way up to like 4.5 in, I don't know, 3.5 weeks, right? So it's like, if this is it, we shouldn't really see rates significantly higher. The Fed is still on their cutting path. The fact that the terminal rate at the Fed is only 3.3, it's 3.3% or something like that right now. So the Fed's not even expected to bring their rates under 3% at all the entire cutting cycle, which again, I think that's a bit aggressive. Some people will say, well, Trump's going to blow out the deficit. The Fed's not going to be able to. They're going to have to hike. That's a very popular countertake to this conversation. And my quick response to that would be, we had Trump in office already. Unless something significant happens, like for example, him lowering income tax, federal income tax down to 0 for Americans, and him not offsetting that with any sort of revenue for the government, I believe that would be a reason why, yes, the deficit would grow rapidly, and you would have a situation where bond yields need to get repriced because you would have a whack on the credit quality of U.S. government debt. But again, I don't know if that is more of a negotiating tactic for him to get into the White House, or if he's going to actually deliver on that promise,
Yeah. But there's always going to be some counter to that as well, right? Like he's not just going to cut the income tax and not supplement that with anything else. He's going to supplement it.
This is true, but it really comes down to this. If you can put tariffs in place, right? So some people are like, oh, tariffs are inflationary. Well, yeah, tariffs to some degree, or after some degree, or at some point become inflationary. But I mean, if you're converting the tariffs, right? Like for example, if you just cut income tax, number one, your deficit widens, right? Because you have no source of revenue. But number two, it's very stimulatory to the economy, right? Because now you have people that are keeping more of their paycheck. They have more spending money, right? So if, for example, if prices are low, it can drive prices up by just cutting income tax. But if you're offsetting that, right, with tariffs, right? And let's just say tariffs do make some goods more expensive, but you're lowering income tax, people now have more free cash to spend. So there's a fine line there where you can actually increase the price of goods and reduce the tax rate without people actually experiencing like wage inflation. right? Because their their income is growing, but so is while the price of goods are going up because of tariffs, their real income is going up because they're getting more bottom line income due to lower taxes.
Yeah.
So it's a very interesting dynamic. You can't just look at one side and say, "Oh, tariffs are inflationary." Well, hiking taxes and adding tariffs are the complete opposite of putting tariffs on and cutting taxes, right? Because putting tariffs on and then hiking taxes, what that necessarily does is you're increasing the cost of some goods, and you're also going to in turn take more of someone's pay, right? So you're going to lower their take-home pay, which basically is like a double inflationary effect on them. They have less money at the end, and they also have to pay more for the goods. So it's net negative for them. So we'll have to see how this balances out. But this is this is a very, I should say, wild to think about, because we don't really know how much of this is going to get implemented, how much of the government excess he can cut. And this is if Trump wins, obviously. Hillary was leading the polls into the election. We don't know. I do think that given where Trump is and his platform, I think he has a good shot at winning, but you never really know. That's why we have elections, right? So we have to see what the people say, what the people vote, and we'll see what happens there in political terms in the next couple of weeks. But ultimately, the bond market and the entire market's front running his odds of winning. That's what we're seeing. Like, as soon as his odds really started lifting off a 50%, bonds started getting hit, and you could even say equities took a little bit of a jump. Not significant in terms of the NASDAQ. We are seeing the SPY at new highs, but the NASDAQ not so much.
Yeah.
And I guess
there's just a lot of uncertainty in the air right now. And I think once the election passes, things will start pricing in reflecting the situation a lot better. That's the way I see it.
Right. So I guess the take on gold for those that are wondering is why is gold going up so much? Well, if you're going to have a situation where fiscal becomes more irresponsible, which is what Trump is seen as on the surface, fiscally irresponsible, gold is going to go up. And gold will trade with an inverse correlation against bonds, meaning gold will outperform bonds. If bonds sell off, it's because of fiscal irresponsibility. Therefore, gold will catch that bid. Gold gets that demand.
But where is everyone getting this idea of his fiscal irresponsibility? Is COVID just skewing that? Like, when you look at the numbers, you just look at the numbers and you ignore everything else. Yeah, that's what it looks like. But is COVID going to happen again, or a similar situation going to happen again? Highly doubt it.
Yeah, so right now the deficit is probably around 6. How should I phrase this? Because it's a negative. It's less than negative 5%, right? So we're spending more than 5% of GDP than what we're taking in the United States at the moment. Well more than 5%. If you look at the COVID numbers, up until COVID happened in Trump presidency, the deficit was under 5. So they're spending less than 5%. Now, you can't look at the COVID numbers and extrapolate that. The other scenario is yes, interest rates are a lot higher. Interest on debt is a lot higher. There's a lot of factors here that weren't there. I mean, we went into COVID, pre-COVID, before COVID even hit, the Fed was under 2%. The Fed is at almost 4.75% right now, right? So it's a vastly different ball game with the debt that's substantially bigger than pre-COVID. But the underlying issue remains, how can you reduce the government's expenditures in a way where you can push some tax cuts through and deliver that fiscal responsibility? And that's a fine line. I mean, again, is the market ahead of itself right now, or are we accurately reflecting some real incoming fiscal irresponsibility? And that's just something that, how markets work. As soon as they get the scent of something, they're going to start moving in that direction until their pricing is invalidated. It's kind of like a wave, right?
Yeah.
As the wave rolls, it builds and builds and builds until it's no more. So it's until the market's proven wrong, bonds may underperform here against gold for some time. I do expect, if we take a look at the gold TLT ratio, I do expect that this entire move here, since pretty much end of September, I think this is all election related. I wouldn't be surprised if we see some relief here in terms of the correlation between gold and bonds, where gold starts to gradually underperform bonds. But I don't think that we really see an entire reversal of this ratio, like a significant reversal, until the Fed can really get rates lower. Like we need we need to get some clarity on the interest rate path. The fact that the market's only pricing in, if it's 6 cuts right now, 6 to 8 cuts on the whole cutting cycle is pretty absurd, right? Some people will say, well, you don't need those cuts. The economy's doing fine. Well, just like everything, just on the way up in the hiking cycle, there are lags to to capture inflation. There will be lags in the cutting cycle as well. So you kind of want to get ahead of the curve there. But I mean, look, you're in Canada, right? So like, what do you when you look at America from outside, like with your exchange rates and whatnot, how are you feeling with like the current situation over there with the dollar?
I feel like America's doing a lot better than Canada. Canada's struggling, especially if you look at the US dollar to the Canadian dollar. US dollar has definitely been strengthening against the Canadian one, and um, Canadian GDP is much lower, much worse situation. That's why Canada just cut 50 basis points again, and they're probably going to continue that. So Canada's in definitely a worse situation, which a lot of countries are as well globally. So I just don't see how America's going to get that soft landing that the market is pricing in when the whole world is very evidently slowing down.
That's a good point. And I guess we can't really see the future in that sense. We'll have to like let it roll in terms of how that happens. But I think the base case, we've made this comment a couple of times, and I think it's gotten lost along the way between the bond trade and like where we sold out of equities somewhere up here. So we cashed out of equities pretty much near around where we are right now on the NASDAQ back in July. And this entire time we've been pretty consistent with the following, that unless you get a recession, stocks and equities can rise together. It's when you get a recession where
You
you
mean
get that
stocks and bonds?
Sorry, stocks and bonds can rise together, correct. It's when you get that negative correlation where you get like that shift from a slowdown to a recession, where you get that strong negative correlation where everything correlates to -1, where the only thing that saves you is essentially bonds. Everything else, or bonds maybe in gold, everything else goes down the toilet, right? That is a recession. And like, as long as you don't get that, stocks and bonds can go up. But if we get like we've seen this slowdown relief the last couple of weeks. And if that slowdown, those slowdown pressures reappear, I think you get a period, an additional period where bonds will again put on a run where they outperform equities. Otherwise, you're gonna be in the situation where stocks and bonds will fight each other for the throne, where they both can rise. So if you stay in a light slowdown, then what's going to happen is you're going to have a situation where equities can outperform bonds. But that's a very fine line, and things move very quickly. GDP revisions can come in very quickly. So it's these junctures in the economy where you want to be very, very adamant and very, very attentive to how these things are shifting, because as things can move quickly, and bonds will, we saw this at the end of July, right? Like out of nowhere, TLT went from 91 to 99 in like a week. So it's very, very sensitive. The economy's in a very sensitive spot where you're going to gyrate between soft landing and recessionary or harder slowdown pricing themes very quickly. And unless you can really get out of this whole rut, I think you need to see the unemployment rate significantly tick lower, and we'll talk about that in the next podcast, but that's what's coming up next week. And if we can see that kind of materialize, then maybe stocks have a better footing and more upside. So thank you so much, guys, for listening. If you have any questions, feel free to reach out to us on X at the Market Radar, or go to our website at market-radar.com.